What's up, guys? Lifestyle Investing, where we invest based off our lifestyle to build that lifestyle.
That's what we're here for.
I know. Do you like your lifestyle?
You know what? I like it. I'm grateful for everything I have. And I am looking in my current lifestyle for opportunities to invest.
Love it.
Yeah.
Love the response.
Yeah, exactly.
My gosh. Yeah, you just read off that script right there.
Yeah, exactly.
That is
right
fantastic.
Yes, excited.
So we're going to talk a little bit about bonds. So last week, one of the
3 and 3.
Yeah. So each week we do 3 minutes, 3 things to watch out for, like 3 opportunities that were that kind of just like came up that maybe you guys can look into, because obviously we can't invest in everything, right? And one of them was the bond market. How there's so many investors investing now in the bond market, and so since Mike is an experto in the real estate and lending fields, we kind of want to go a little bit in depth of the correlation between bonds and real estate.
Okay.
And especially since too, like the rates are going to be, they're saying that they're going to do another rate hike in December. Right. There's only one this year, right? I think there's only one rate hike this year.
I think there has already been one.
Yeah.
So there might be another one.
That's
talking about the variable rate, the prime rate is what they call
it. The prime rate. But I think there was one. I think there was one like in Q1 or something like that.
Right.
Yeah, they were going to do one over the summer, but they didn't do one.
Right.
And then now they're supposed to do one like December 12th or 13th, something like that. So
So there's a couple things to talk about on that.
What things are you going to talk about?
Well, because bonds, the bond, when we say bond, we're talking about like a government-backed bond. So there's like the T-bill, that's a bond. There's municipal bonds, which is like you could loan. You're basically in a bond, you're loaning money to the government. So if you give a city municipal bond, you're basically giving the city of Kent or wherever you live, you're giving the city money to do like road work or whatever. Like that's a bond.
Mm-hmm.
And it could be like a 3-year bond, a 5-year bond, 10-year, whatever. Like if you're donating or giving the money to a city, and they're guaranteeing you a rate of return.
So they're in debt to you, right?
They're in debt to you.
So if we buy
money,
we buy a bond from the city of Seattle, right? We buy a $100 bond, then whatever the coupon rate or whatever is, right? Then they have to owe that back, right?
Yeah, it's very low risk for the investor because you can trade it. In other words, you can get out of it whenever you want. It has a price. You know what I mean? So like, it's not like you have to keep it for the whole term. It's like an article of worth. So say if you buy one, even though it's a 10-year, you don't have to hold it the whole 10-year. You just can let it go for the current rate of return. So it's that kind of thing. And so it's low risk because you're pretty much assuming that the government's going to pay you back.
It's true.
And so those are the
reasons. Some governments are a little bit risky on that. Right?
Yeah.
Right. If you buy a bond in Venezuela, where they have a lot of issues with their currencies, or some of the places like, in the Middle East where they're having some political issues.
Yeah.
Right? I mean, are those countries going to back it? Maybe. Right. You hope so.
Yeah. And I don't even know if you can legally buy any of those, at least not in the standard way that you can buy the ones that we know about.
Probably not.
Yeah.
And, probably not. But why do it legally?
Oh, yeah, that's true.
I know. Why?
Yeah. Illegal money is better. It's more illegally.
Oh.
So the reason why it affects the interest rate on a mortgage is because it's the same kind of investors. So in other words, if somebody is in the market for a low-risk investment like a bond, mortgage is not that much riskier because it has a house as collateral, and it's a long-term deal. So if the bond rates go up, then mortgage rates have to go up to attract the investors. Because the mortgages are traded as a security. So basically a mortgage company will pool a bunch of their loans and sell it to Fannie, Freddie, Wells Fargo. I mean, some investor buys it. Yep. And then those guys are publicly traded. So they're also, you have access to those loans through mutual funds that the companies are offering. Mm-hmm. So if the T-bill or the bond rate goes up, then the mortgage company has to raise their rates to offer a more sweet investment to the investors. So they're basically saying, okay, the bond rose to here, we have to raise the basic mortgage rate. Otherwise, all these people who are looking for this mortgage investment are just going to go to bonds.
Interesting.
Yeah, so it's really just to compete. It's not like they're not actually connected in a really like a causality kind of way. It's more of a correlation because they'll see if the rates go down, then people will go over the mortgage rates if they're paying more.
Mm-hmm.
If the treasury bill goes up, then people buy on those. And then another thing that happens through that whole thing, and it's what kind of connects them, is that when the interest rates of a mortgage rise, like say if the current 30-year rate is 4%, if that's better than the market, let's say one bank out of 4 has 4% and the other 3 have 4.25%, the market's going to flood to that 4%. So basically, if you're out there rate shopping for a home loan and you check 4 banks and one of them has a lower rate, you're going to go with that lower rate. So that just could be what the bank is wanting to do more of right now. And on another side, and this comes from like kind of inside baseball, if the underwriting is slow, meaning the underwriters are backed up, they will raise rates. The mortgage rates will go up temporarily. And on a bank that's big, like a huge national bank, raising the rates just a little bit will give the underwriters enough time to catch up. Because 1 or 2 days without a huge flood of applications gives underwriters a couple days to catch up. So
that's crazy.
Isn't that weird?
Holy smokes.
Yeah.
So back on the bond and bond and interest rate, I think we only got like 30 seconds left.
Okay.
Actually, check this out. Next video, we're going to do a part 2.
Part 2.
So if you love what Mike was talking about and what I was talking about, I highly suggest. Yeah, peanuts are good too. I highly suggest you listen to part 2. So we're going to wrap up right now. Mike, Bernie.
Yep, we'll be back
in a few.